Check this out. On December 30th, 2021, someone asked Elon Musk, when do you think the next recession will be? He replied with, predicting macroeconomics is challenging to say the least, but my gut feel is maybe around spring or summer of 2022, but no later than 2023. Since then, Meet Kevin liquidated his entire portfolio, has gone purely into cash, and is even trying to raise money to catch the bottom of the housing market, and has been on a rampage of negative Nancy posting. And taking a look, guys, gross domestic product sales, the thing that predicts this recession as we sit in the fourth quarter of 2022, guys, looks like we're not really seeing any major recession. In fact, we only had 2 quarters of really mild negative GDP that were nowhere near close to what we experienced back in the pandemic. And if you take a look at the inflation numbers, well, since July, guys, inflation is basically back to a nominal rate. And damn it, the US dollar, which no one really wants to talk about, is seeing levels it hasn't seen since the dot-com bubble. And if we're just getting warmed up here, folks, the quarter that was supposed to absolutely wreck everybody, well, Apple posted net product sales here, guys, of $394 billion, a record revenue quarter. Microsoft, over $50 billion, a record revenue quarter. Amazon did $364 billion, a record revenue quarter. Google, the one that should be getting hit the hardest with advertising rates, revenues hit $69 billion, a record revenue quarter. And damn it, even Dogecoin has been able to rally 100% just in the last month. Now, we're going to dive down into my $377,000 dividend stock portfolio, as arguably over the month of October, I've invested more money since the beginning of this year because of the insane amount of fear that I believe is leading to discounted opportunities in the market. And I want to prove to you why optimism, diligence, and cost average investing over periods of time will always prove to be more prudent and more fruitful than trying to time the market or listening to these people that I honestly think at this point are just spreading FUD. Now, I'm not trying to paint the rosiest picture because the market is not perfect, but you can only take the information that you have and try and stick to a plan. So in the clarity of my transparency, this is a conversation you appreciate. Hit that like button, folks. Is first and foremost taking the broad view of my entire portfolios combined in this spreadsheet. The total value today is $346,000 with a cash value of around $31,000. But when we take a look at my annual dividend yields here, guys, they have been consistently going up, not only because I've been adding money to my individual positions and my ETFs, but because these ETFs have historically paid out more through 2022 than they have any year prior. But taking a look, guys, this has been a really well-balanced portfolio as I continued to buy a lot of VDY, which we'll take a look at my Canadian Vanguard High Dividend Yield ETF, and along with VOO, because I think VOO, guys, has become very well balanced with a lot of energy and other stocks starting to make up the S&P top 10, balancing out some of the tech volatility. And we'll come back to this toward the end. Now, before we dive into the individual accounts, if you guys enjoy this spreadsheet overview, I put an incredible amount of work into this so it properly converts the currency. It automatically tracks the stocks and the updated dividend yield. You can come on over to the portfoliospreadsheet.com. You can purchase this, guys. You can utilize this on your phone through iCloud numbers, and it's just a really great tool. It's only $12.99. It'd really support the channel, and I greatly appreciate it. But taking a look first and foremost at the TFSA, just to show you guys, since I've been cost averaging into these, reinvesting the dividends, I have everything set up on a drip here, guys. We can see now on VDY, I'm only down about 2%, and on VOO, I'm only down about 5%. This is a lot better than where I thought I'd be at this current time in this market cycle and toward the end of this year with the just insane amount of FUD. The TFSA is worth about $154,000. Taking a look at my basic managed account here, guys, where I hold my individual REITs, where I've been experiencing the greatest downside because during the pandemic I picked up most of my RioCan. I'm now up actually still 15%, which is kind of getting canceled out through my Smart Centers investment here, which is down about 13%. But again, VDY, where I invested another $5,000 through October in this account, almost a value of $20,000. Well, $20,000 invested. Market value today is just under $20,000, is only down 1.88%, with the combined value of this account being worth just under $40,000. And then finally, my RRSP, my registered retirement savings plan, where I do keep a lot of my US dividend ETFs because this account waives all the foreign withholding tax. So I keep my higher yielding US stocks in here, which today is worth about just under $65,000. 30,000, but I am down only 1% on SCHD, and on VYM only down 2%. Again, I'm not going to take into consideration my corporate account, which is combined in that portfolio overview spreadsheet, because I'm going to keep that personal just for a little bit longer here, folks. I know a lot of you wanted me to do videos on my corporation and the tax advantages and the loopholes I'm taking advantage of, but I'm going to save it for a very specific video in the next week or two. But let's take a look at these individual positions themselves and just how they've been performing through this year. As first and foremost, the SCHD, the ticker symbol for the Schwab US Dividend ETF, probably one of the most pronounced ETFs amongst the entire dividend investing community, is only down 8% here, guys. But I wanted to show it to you because first and foremost, the dividend payouts have pretty much hit a record coming into the midst of 2022. This thing pays well over a 3% yield and has been performing just fabulously, basically kind of getting some of these healthcare kind of tech-based companies like Merck & Company, Amgen, IBM, PepsiCo, Lockheed Martin, which has just been crushing it this year. Lockheed dealing with all the geopolitical events. It's a company that makes basically warfare-based stuff, jets, rockets, things like that. We got Pfizer in here, Cisco, Home Depot, Coca-Cola, a lot of incredible companies. And the reason I favored these over the individual positions is because these ETFs do a wonderful job at properly weighting them. I know a lot of people love like the likes of PPC. Ian, I used to be a very individual stock dividend focused investor, but over time, as your portfolio scales, I just don't see the prevalency in buying 40 or 50 dividend stocks when you're basically just doing an ETF where you yourself, I don't think, can properly manage a 40 or 50 stock portfolio. But that's just my personal opinion. Taking a look at the Vanguard High Dividend Yield ETF here, guys, VYM is only down 5.18%. I don't know too many investors out there that can show me accounts or returns that look like this over 5 years, even buying those individual dividend stocks at the likes of Johnson & Johnson, which is the top weighting of VYM, along with ExxonMobil. And I had to admit here, guys, ExxonMobil is up over, 70% year to date. I'm not a fan of oil, but I know my own pitfalls, and I don't do enough due diligence. I don't know every sector. So to sit here and say, oh, I know exactly what I'm doing buying individual stocks and missing these huge opportunities seemed very ignorant, whereas these ETFs, they do not judge a company. They judge based off market cap, revenue growth, dividend payouts, aristocrats, and things like that. So we've got the likes of JP Morgan, which I think is a great discount, but if you only bought the banks this year, you would be getting absolutely devastated. You got Procter & Gamble, Home Depot, Chevron, Eli Lilly, Pfizer, AbbVie, all these incredible healthcare companies with a dividend that, again, not nearly as explosive as SCHD, but damn, it is still paying out record dividends for this year. And finally, VDY, well, not finally, because we're going to take a look at the S&P 500 still, but the Vanguard FTSE Canadian High Dividend Yield ETF, my best performing investment thus far this year, because it's now only down 3.78%, yields well over 4%, which means if you tap on the dividend this year, guys, you actually are just flat for the year. Now, this one, I know the performance isn't as incredible, but the reason that I fixate on this one so much is because the monthly payments that it makes in Canadian dollars to my account, which again hit record payouts this year, which I absolutely just love as a dividend kind of focused investor. And this ETF encapsulates everything I love about the Canadian economy, with the banks making up the top weightings: Royal Bank, Toronto Dominion Bank, Enbridge. This thing is a beast this year. Bank of Montreal, Canadian Natural Resources, some of those, again, oil energy stocks that I would have broadly overlooked if it wasn't for these ETFs, guys. Suncor, you even have Bell and some of those incredible telecom companies. And that's just the top 10. They do encompass all those other awesome stocks like your Hydro ones, your Fortis, and TELUS, and all those other wonderful stocks that I'd still consider buying individually if those are the kind of investments you're fixated on. But finally, just take a look at the S&P 500 here. Now, I know a lot of people are really negative about this, but again, if you only bought tech stocks, there's a very good likelihood that you were picking up things like perhaps Facebook stock, which again, I still think, after those earnings, yeah, they're spending a lot of money, but their underlying business is still growing and it's still pretty resilient nonetheless. But the S&P 500 is only down 18% on a 5-year basis, is up 50%, still performing pretty resiliently. And if you take a look at the top holdings, they've been shifted around a lot. I talked about this in my live stream last week here, guys, but we can see that ExxonMobil is now back in the S&P top 10, along with Johnson & Johnson and United Health, kind of replacing Nvidia, Meta, and I think JP Morgan that used to be in the top 10 list. So because this auto weights by market cap, it is naturally de-weighting the stocks that are underperforming, so you're not nearly as overexposed. And Apple, guys, sitting at the top of the list, proved to be one of the most resilient companies, and another reason you just do not bet against Apple. The conspiracies and the amount of people on Reddit coming out thinking this was the end of Apple stock, that we were going to finally see a major slowdown or a negative, growth in iPhones, continued to be proven wrong, to even my own insane delight here that's still happening. I mean, at what point does Apple finally peak the iPhone market? How are they pulling these numbers off? Nobody knows, but damn it, I'm glad they are. In these top three companies up here, Microsoft and Amazon, just damn near crushing it. Now, finally, I want to state the biggest thing that changed for me this year, and something that I think is broadly overlooked, is an emergency fund, guys. I'm always going to keep $30,000 in cash. You tap on the $12,000 I'll make in dividends over the year. That gives me a full year's worth of emergency fund, and this is coming from a guy that lost his entire career of 10 years in the March 2020 crash, has done major pivots, and now is doing YouTube and stock market stuff full time, but is still seeing a decline even in my current revenues because of the macroeconomic events. And all of that fear is derived to me that you got to make sure you have some cushion. Your car breaks down, you hurt yourself, you can't do your job. I just don't want to be in a position where I'll ever have to sell these stocks. And I think through the experience of this YouTube channel and where I was when I started this channel in 2019, I've evolved into this a whole new level that many of you OGs are starting to see, and it's something I'm going to continue to do for the time being. So if you guys do appreciate my portfolio overviews, let me know what you think in that comment section below, and I'd love to know how you're doing, what you're buying, and how you see the market. Even if you think the market's going to continue to crash, I'd love to know why in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.